Hey guys, it's Brian. Welcome to Financial Fitness. If you're new to the channel, please subscribe. In this video, I'm going to talk about what a margin account is, how margin trading works with some examples of pros and cons of investing on margin, along with an explanation of margin calls. Let's get started. Margin accounts are non-qualified accounts, and that means they do not have beneficial tax treatment like in qualified accounts, such as an IRA or 401k. Before anyone can begin margin trading, a margin account would need to be opened. Accounts can't be used to trade stocks on margin with less than $2,000 of cash, and some brokerage firms require more than $2,000. A margin account is a brokerage account where a broker lends the investor cash to purchase stocks or other financial products. Any money loaned within the margin account is backed or collateralized against any securities purchased and cash. Margin loans have set interest rates based on the amount that is borrowed, and those ranges are set by each broker. By investing with borrowed money, the investor is able to leverage the additional money to purchase more shares of stocks or other financial products than they otherwise would be able to with just their own cash. This gives the investor a chance to amplify profits and losses. So the main advantage of using margin when investing is obviously to potentially make money and additional profits, also known as gains. If an investor purchases stocks on margin and they appreciate in value beyond the cost of the margin interest charged, that's how profits are amplified beyond what they would normally be able to purchase with just their own cash. Gains are amplified, especially if the trade appreciates in value quickly, limiting both the actual amount of margin interest and the amount of days margin interest is being paid on. This is the best case scenario of flipping a stock fast on margin. Buy a stock, hold it for a few hours or a couple days, and have it appreciate in value. Then sell it to collect the profit and stop paying margin interest. The second advantage of using a margin account is that it allows an investor to buy and sell within the same trading day and bypass the normal trade settlement. Without it, an investor would need to follow T+2, which is also known as trade date plus 2-day settlement. This means that the date a trade is made plus 2 days to settle the trade would have to pass before it is officially sold or bought. I'll go into more detail later in the video when I talk about margin interest. A regular non-qualified cash brokerage account would have to wait out the T+2 when buying stock and also T+2 when selling stock. An example would be if an investor has a regular brokerage account with $5,000 to trade, they could buy $5,000 worth of one stock on a Monday, and the soonest they could sell is Wednesday. This is relevant because in order to use the same $5,000 to trade quickly, it would still take a full week from buying and selling and then potentially starting the same cycle over again by Friday. If an investor has a cash account and tries to buy or sell too quickly without settled money, they could get a warning that points to a possible good faith violation. It should read something like this: the buy order you are about to place exceeds your settled cash balance. Selling these shares before paying in full for the trade could result in a good faith violation. Read avoiding cash account trading violations for further clarification. These types of violations, if you get somewhere between 2 to 4 of them in a 1-year period, the brokerage firm restricts the account for about 90 days to make sure you only use settled money to place trades. There are downsides to using margin as well, and they can outweigh the advantages of using margin in some cases. The short version of describing the disadvantages of using margin is what happened to a lot of investors in March of 2020 when the stock market was dropping over 1,000 points a day for a couple weeks, causing margin calls. If you look at any of the major indexes, you can see drops in the charts where margin calls were a large part of what caused indexes and stock prices to drop so much and so fast. So a brokerage firm charges margin interest as long as a security or stock is purchased until it is sold. The longer the stock is held, the more that the margin interest builds up. If the stocks purchased on margin drop in value, the investor will be paying margin interest on top of losing money. Keep in mind, money is not officially lost or gained until the investment is actually sold. Assuming the stocks purchased on margin drop in value, there is a maintenance margin level that must be maintained, usually around 50%. But this can vary slightly between brokers and the total value of your portfolio. When stocks appreciate in value while on margin, this is not a concern as value is being added to your portfolio. As stocks drop in value when purchased on margin, the equity could drop below 50%. FINRA has a maintenance margin of 25%, but brokerage firms usually have a higher requirement between 30 and 50% to help protect the money they lend to investors. So check with your brokerage firm to see what their maintenance margin requirement is to know what boundaries you need to invest within. In my examples, I will assume 50% to be on the higher end of the requirement, but the concept will apply regardless of what the percentage is with your broker. When the maintenance margin drops below 50%, the broker has the right to make a margin call to the investor, giving them around 1 to 3 days to either sell stock to cover the margin call or deposit extra cash into the brokerage account. Both of these two options bring the maintenance margin back above 50%, but the investor would essentially be taking losses or depositing money. Typically, when going on margin, as an average investor, there may be no additional cash to deposit, which means the only option is to sell stock at a likely significant loss. An investor has potential to lose more money than the cash in the account because of how maintenance margin and margin calls work in the event that holdings depreciate in value. And to be clear, the account goes on margin. It is not holding specific. With this in mind, the average Robinhood brokerage account balance size is somewhere between $1,000 to $5,000. Let's go over an example where maintenance margin comes into play. Assume an investor has a $10,000 portfolio and buys $10,000 worth of stocks, then utilizes margin to buy another $10,000 worth of stocks. The total value of stocks purchased is now $20,000 with a 50% maintenance margin. The investor puts themselves right up against the maintenance margin, or what I call the cap of how much they can buy even with margin. If the stocks purchased drop in value down to $15,000, yet the investor is still borrowing $10,000, the drop in value comes out of the investor's equity, and the cash used to purchase those stocks is what drops by $5,000. When this happens and the equity in the account drops below the maintenance margin, a margin call is issued by the broker to the investor. The investor is given 1 to 3 days to resolve the equity deficiency on their own. The investor would need to come up with $2,500 or sell a $5,000 portion of the stocks to come up with the $2,500 to maintain the 50% equity requirement. If the problem isn't resolved by the investor within the given 1 to 3 days, the brokerage firm can sell some holdings to come up with the cash or equity to maintain the maintenance margin, or cash is deposited so that the stock positions do not need to be sold within a couple days of the margin call being issued. This is even more relevant after recent events with GameStop. In 2021, when the price of GameStop was wildly fluctuating up and down and shares were being purchased by investors on margin. Margin calls also heavily impacted many investors in March of 2020 as well during the huge sell-off until the rebound started after March 23rd later in the month. So a rule of thumb that I recommend if you use margin at all is to not buy right up to your brokerage firm's maintenance margin cap, because any drop in stock prices could cause a portfolio to drop below the maintenance margin and cause a margin call. Going back to my previous example with a portfolio value of $10,000, instead of buying another $10,000 of stocks, leave some space and buy a total of $5,000 on margin so that you aren't forced to sell your positions when you are not ready to do so if there is some price fluctuation in the market. I would highly recommend understanding the additional investment risks and requirements of trading with margin before actually trying it. It is likely safe to say, even if you understand the risks after watching this video, that the first couple $1,000s you might try to invest on margin will likely be lost, but only do so if you intend to use it as the cost of learning from your experience. Now that you understand how margin calls and maintenance margin can impact your portfolio, it's helpful to understand how margin interest is calculated on what you might borrow. Each brokerage firm will have set ranges of what they charge for various amounts borrowed. They calculate it based on the amount that is borrowed and by the amount of days the margin loan is outstanding, which includes weekend days. Here's what margin interest rates look like for TD, Ameritrade, and Fidelity. Keep in mind that if you invest on margin, you should not stay on margin for that long because the interest will add up and eat into your profits or further increase your losses. If an investor has a high volume of day trades, buying and selling the same security within the same day, then their brokerage account can get flagged as a pattern day trader. If an investor executes 4 or more day trades within a 5 business day period within the same account, pattern day trader has a requirement to have a minimum of $25,000 in portfolio value in the margin account. If the portfolio drops below $25,000, then the brokerage account can be prevented from executing day trades until the balance is brought back up above $25,000. Generally, the pattern day trader designation places certain restrictions on these investors to discourage investors from excessive trading. To summarize, here are the key points for margin accounts: maintenance margin, margin calls, and pattern day trader. Be careful when trading on margin to not go too deep on margin up to the maintenance margin limit and trigger margin calls. Understand how margin calls work and that declines in portfolio value can cause a portfolio to drop below the maintenance margin. If a margin call is issued, there are only 2 ways to resolve it: sell some holdings or deposit enough cash to bring your portfolio back up to the maintenance margin level as required by your broker. Margin interest can add up fast. Try not to stay on margin for too long unless you can actively book profits and gains. Try not to hold losing positions for too long while on margin, because the combination of equity declining and accruing margin interest could diminish the value of your portfolio, especially if you get a margin call. If you get flagged as a pattern day trader, keep in mind that you will need to maintain a minimum of $25,000 of portfolio value. Learn and know your limits when investing and trading on margin, and only take calculated risks within your means and within the limits of your portfolio. Thanks so much for watching. I hope you liked this video and found it insightful. Click the like button if you did, and please subscribe if you haven't already. Click the notification bell so you can see when I post videos next. Feel free to leave comments, questions, and any topics you might want to hear about in future videos to get on track to being financially fit. See you in the next video.